perennial problems of our continent. I was mentioning some economic history with regards to financial crisis. Particularly, the field of macroeconomics has changed a lot since the 2008-2009 financial crisis. But if we'll go back in history, we know between 1929 to 1933, there was a Great Depression, which led to the loss of a lot of jobs, as well as a global economic meltdown and breakdown. But between the period that is characterized by great moderation, we see mid-1980s to 2007 as a period of very, very good macroeconomic stability. There were shocks, there were structural change, meaning the relative importance of services have increased compared to the contribution of agriculture and manufacturing, and there were good policies. So that is why the period between 1980 to 2007 was characterized as a period of great moderation. But after that, we know what happened. There was a financial crisis in 2008 and 2009, starting from failure of big banks in America, and that is classified as a Great Recession or the financial crisis of 2008. And this was precipitated due to reckless lending by banks, giving loans to people who cannot really pay back the loans, and a lot of Ponzi schemes whereby mortgages were repackaged and insured without really making the financial system stable, which eventually led to a systemic risk and a decline of many, many banks simultaneously, and that broke down financial institutions in the global economy. And this will change the way we think about macroeconomics, because the finance sector is related to the real economic sector, and we should really think the way we do macroeconomics in the future. And the crisis, as I mentioned earlier, it was a big shock for the study of macroeconomics. And for sure, now, because of that, we know financial market disruptions are central to macroeconomic crisis. And aggregate fluctuations or short-term aggregate fluctuations, they should be controlled or should be managed. Therefore, regulations are important in that. And because of the various repeated shocks or financial crisis, we witnessed high levels of unemployment and high costs of living, which really make life uncomfortable for many, many regions in the globe. So financial market instability, as far as it exists, the challenge is to understand why tight monetary policy was not central. Therefore, we will discuss this in the various topics that we are going to cover in this course. And because of the crisis, we have to expect that macroeconomics will have some large and unexpected changes. And the modeling, the forecasting, and all the studies that we do in macroeconomics will be influenced by the insights that we get from the financial crisis of 2008. The 2008 financial crisis or the Great Recession, the areas receiving heavy criticism have been economic forecasting and macroeconomic modeling. As we know, the use of dynamic stochastic general equilibrium models was questioned. Now, there is also more emphasis on regulation and compliance procedures that need to be followed particularly by banks. So central banks, as controllers of different banks within a given system, have central role or important role. The regulation of banks helps to reduce risk-taking behavior and avoid the relapse of contagious or systemic financial problems or financial crises. But many banks seem not to really learn from the 2008 financial crisis. As we know, there are a lot of African banks which are carrying non-performing loans, and the system, the financial systems that they are based on is fragile. And if you want to get more insight into these issues of bank fragility in Africa, we have estimated a dynamic panel data model on many banks using bank scope data and published a research last year. So the reference is provided in this slide, and I encourage you to go and read this paper to get an idea of what is behind the building up of non-performing loans in the African context. And we provide a lot of bank level variables as well as macroeconomic institutional variables behind the building up of non-performing loans and the fragility of the financial system in Africa. And I hope that will give you some important insights if you are really interested in bank fragility in the continent. So what are the lessons for macroeconomics as a field? I think understanding the vulnerability of financial markets to bank runs or quick bank collapses is one. And from the crisis, we also learn how we can predict the probability of default by credit agencies and doing that better, because predicting the probability is not enough. At the same time, the system should also focus on the circumstances under which defaults occur. Therefore, we have a lot of contextual information. There are financial market imperfections which are important both to conventional as well as financial firms, which should also be studied. And credit market crisis was transmitted to the rest of the economy. Therefore, there is a strong link between the financial and the real economy. So decline in investment and economic activity will be followed as soon as you have a financial shock. And firms will be credit constrained, so they cannot invest and they cannot expand. And that will reveal itself through higher unemployment in the economy and also a lower welfare to overall society. In terms of understanding the financial crisis and its impact on the macroeconomy, we know that we need to think harder to understand the transmission mechanisms. How come the financial collapse of banks is related to macroeconomic collapse? So we need to invest a lot of time and also intellectual effort to understand the transmission mechanism. And that can be direct or indirect in the form of confidence and uncertainty on households and firms. And understanding the channels is an open research question. We cannot really answer it in this lesson, but it is an outstanding question that researchers are spending a lot of time on. And in many cases, interest rates were cut to encourage investment, to encourage growth, and also improve the recovery from the financial crisis. So if banks were cutting interest rates below this lower bound, because zero is a lower bound, the downturn could have been less severe. That's why I think in many cases you hear current reports whereby central banks are not really raising interest rates, rather some of them have been regularly cutting interest rates to boost investment and also kickstart economies and on the way to recovery after the crisis. So the recovery from the crisis could have been better if monetary policies have intervened much earlier. The political economy issues that are emerging from the insights of the financial crisis are important. For instance, most commentators and experts say that the financial crisis happened because we left the regulation of financial institutions without it being implemented. There are regulatory authorities, there are regulations written, but they were not implemented. Therefore, the regulatory decision-making of policymakers was really weak or wrong before the crisis. Now that is being revisited. So regulation was non-existent or was very light in the past. When policymakers in advanced economies were warned about overvalued asset prices, such as households in the real estate market, the decision makers didn't really take any meaningful step to correct things. Therefore, we had the crisis. Therefore, the clear policy conclusion is that regulation should be implemented. Macroeconomic modeling and forecasting is a machine and data-intensive art. And we know that this is an area of macroeconomics which is really affected by what we have been witnessing as a financial shock in the past. Therefore, now the general direction of thinking in recent years is the need to develop complementary policies to improve the robustness of policy decisions. There are existing popular models such as DSG models, and each country, particularly banks, central banks, have adopted them, but they rely on unrealistic assumptions such as the representative household, an average imaginary household which can really represent all households in an economy, and this is very unrealistic. Therefore, there is a lot of work towards improving the assumptions that are the building blocks of the DSG models. So these unrealistic assumptions should be realistic. And the critics include the famous Paul Krugman. The most important lesson that we have seen in the last decade after the crisis is that we can rely on models, but we shouldn't rely on a single tool, because that can be dangerous. Therefore, in the forecasting field, experts use parametric and non-parametric forecasting. They use also univariate and structural forecasting, meaning focusing only on one variable or a system of variables to forecast important macroeconomic aggregates such as exchange rate, GDP, interest rate, and so on. Disaggregated and or aggregated forecasting, short horizon and long horizon, including interval forecasting. So these are the efforts by experts to diversify the tools of forecasting, or the tools of the trade, if we like. So the most important key message I would like you to take is that we do not really reject existing models and also just adopt Keynesian style models. For instance, you cannot just simply say, oh, DSG, unrealistic in terms of assumptions, particularly with representative households, and let's just pick traditional Keynesian style models and put complete trust on other models such as unimproved versions of DSG, as we call them, the new Keynesian DSG models. All of them have advantages and all of them have disadvantages. Therefore, the turning point, or the time when the financial shock hit the planet, the turning point hasn't been predicted by all of them. Therefore, a concerted effort is very important on the way forward, how we can really forecast future outcomes and how we regulate important economic agents such as banks in an economy, so that we will not face similar macroeconomic collapse as well as financial crisis. Identifying a turning point is identifying the point by which the crisis might happen. And it is very important to give an idea when, or probably the interval period by which economic collapse might happen. Many inflation models fail to forecast turning points adequately because they miss key underlying long-term influences. If inflation falls rapidly, such models can underestimate the speed at which interest rates should fall, damaging growth in the process. Therefore, we have different lessons in terms of predicting the turning point or when the collapse happens. Projections or conditional forecasts about macroeconomic variables are important, and they give you a clear picture how the state of the economy is likely to perform in the near future. That's why reports such as the Economic Report on Africa or the African Economic Outlook, which is produced by the African Development Bank, OECD, and UNDP, are based on forecasting or projecting because they want to feel what is going to happen in the continent in the coming 2-3 years at least. Therefore, they really are important in giving you a general picture of growth. For instance, variables such as inflation and GDP are closely followed, and we monitor them. In the early 90s, IMF and the World Bank, the Washington institutions, alerted African policymakers about the importance of forecasting. Therefore, forecasting has become important. So far, macroeconomic forecasting in Africa has been highly dependent on the developed world economic pattern. Most macro data of Africa comes from IMF and World Bank for forecasting. I witnessed this when we were writing the Ebola virus disease report for ECA in 2014. I made this point about the source of the data because in future, African countries should have developed or should develop a database which can be a source of economic and social development outlook. And the data that should really speak about current and future social and economic outlook of Africa should be based on data sources which are aggregated and compiled by African institutions. So in Africa, there are many countries which have a development vision, and in their vision statement, many countries have drafted policies for economic growth for 5 years or 10 years. Some of the countries with visions include Kenya, Ethiopia, Tanzania. In some cases, some countries are putting time limit for their ambition to be a lower middle income country, such as my country, Ethiopia, by 2025. That is in the space of 6 years. And take also the case of MDGs. These are the development goals before the Sustainable Development Goals, which have a target of 6 to 7% in terms of economic growth. And we know that the Sustainable Development Goals also run between 2015 to 2030. So many countries, they try to align their visions with these global goals. So 2030 is a critical point when countries review their progress with respect to achieving all the 17 Sustainable Development Goals. Now, to conclude our chapter, I will give a brief overview of the recent economic and social developments that we have witnessed in Africa. Generally, there is a positive global economic movement in 2019. There was a lot of global investment and trade in developed and emerging market economies. But the recovery is still very limited, even in advanced economies. After a collapse of the oil price in mid-June 2014, there is a rebound in terms of commodity prices outlook. Therefore, prices are increasing. And U.S. Federal Bank, the Fed, has also regularly cut interest rates to boost the recovery of the American economy, because this is an economy which has an impact on many other economies in different regions globally. This has helped for a positive economic outlook in the global scale. But at the same time, there are some factors which contributed to negative economic developments in the globe. For instance, we know that US and China have started trade war or trade tensions. Because of the structural change that is happening in the economy of China, we see a slowdown in China. And there is also a standoff between the West and some important Middle Eastern countries such as Iran. And there are also emerging economies that are not really making the growth that is expected. The good case is that the Brazil economy is not growing as it used to be in the past. Therefore, there are some reverse movements in economic development in emerging economies. And we know the much popularized Brexit, the process of UK negotiating to be out of the European Union soon is also affecting business. It is affecting jobs. It is affecting investment and trade links. And in terms of future economic developments in Europe, Brexit will have an important impact. What is the outlook for Africa? In this case, I would like to encourage you to look at the statistics and the figures in the report. There was a slight growth decline in 2018 relative to 2017, but there is an expectation that it will increase in 2019 and 2020 based on forecasts from ECA and African Development Bank. The next important outlook is exporters will benefit because oil price is increasing. With tension in Iran, as we explained earlier, global supply is being affected, and speculations also will play a great role in keeping prices for oil higher. So oil exporting African countries will be benefiting. Inflationary pressures mount for oil and commodity importers because of the price rise of imported items. And fourth, political tensions lead to a reduction in inward FDI for some countries, for instance, in Central and Northern Africa. Also, some of the economic tensions that we see in East Africa because of some instability in places like Ethiopia might lead to a reduction in foreign direct investment. And big African economies might enter into trade deals with the UK after its exit from the European Union. If Brexit happens, Africa might be a beneficiary, so it might be an opportunity. This is also seen by the visit of the Prime Minister of the UK to major African economies such as South Africa, Kenya, and Nigeria. And another important outlook is the strength of the dollar, which will be damaging to Africa because most of the debt of Africa is held in dollars. The servicing of debt will be expensive, and the nominal value of public debt will be very expensive as the dollar gets stronger. Now I will focus a little bit on current positive development in Africa, such as investment in infrastructure. Africa is not recognizable compared to what it was 20 years ago. There is a lot of good roads, good bridges, and rail networks being built. For some countries, weather has contributed to good harvests in the year 2018. And there is also a growth in private consumption, which shows that households are to some extent benefiting from the economic growth. But we acknowledge that the growth in Africa has never been equal in recent years. That's why there is a consensus in the development economics community that Africa's growth should be more inclusive. There are very good improvements in terms of trade and investment links. The recent completion of the African Continental Free Trade Area negotiations might lead to positive intra-Africa investment and intra-Africa trade, which we will all benefit from. And another positive development since 2017 is offshore and onshore oil and gas discoveries in many countries, such as Kenya, Tanzania, Mozambique, Uganda, and this has led also to improvements in growth for not only the general population, but for females, which is encouraging. And finally, I should say that the revival of the oil and gas discoveries in Africa is a good thing, but we need to address the skill shortage in the area. The growth features of resource-poor African economies is different from the oil exporters, but some of the resource-poor economies are also well managed, such as Senegal, Ethiopia, and Cote d'Ivoire, which are doing very well, even better than the oil exporters. I think you can see that from figure 1.5 of ERA Chapter 1. Most of the growth is public sector investment driven, not via entrepreneurship. Most of the growth that you see in these three countries, Senegal, Ethiopia, and Cote d'Ivoire, are not based on private sector development, but most of it is driven by good economic management by government, good infrastructure development, good economic policies put in place, and also a concomitant increase in public sector investment in different economic sectors. As a question, I pose the following. What does this imply? For instance, if growth is always driven by public sector investment, is it sustainable? I think the question that we might ask is whether the growth that we see in the continent is sustainable. Because the implication is that the sustainability is worrying, because you cannot really expect government to spend a lot of investment for many, many years to come without challenge in terms of sustainability. But if growth is driven by private sector development, self-employment, and the entrepreneurial spirits of the whole population, I think growth will be sustainable. And how do you see Africa's growth in terms of development or financing its future growth? I think there is a technical paper that myself and my colleagues at ECA published in African Development Review, and I would like you to refer to that paper.